In the last 5 years, 3M is down 50%. Year to date, it's down 15%. And during this past month, 3M has been all over the news. 3M agrees to pay more than $5.5 billion over combat earplugs. 3M stock soars on reported earplug settlement. $5.5 billion is a win for investors. 3M jumps on reported settlement. 3M company, I still believe the dividend is safe, for now. 3M lifts Dow Jones Index on reported $5.5 billion settlement. So for the rest of this video, we'll see a bunch of stars at the top of the screen. A star will be added every time we have a good metric. The more stars, the better the business. As it pertains to expected growth, 3M's next year's projections are a decent 9.6%, and the next 5 years looks like that growth will slow at 1.91%. When it comes to key valuation metrics for 3M's price-to-sales ratio, it's lower than its 5-year average and still lower than the index. We want it lower. For its PE ratio, it's high, almost non-existent than its 5-year average and the index. We also want that to be lower. For price to cash flow, it's lower than both the 5-year and the index. Again, we want that ratio to be lower. With price to book, it's lower than its 5-year, but higher than the index. For the PEG ratio, we want that ratio to be above 1. We see it at 6.14, which makes it even better than its above 5-year average. When we look at operating performance, for 3M's return on assets, it's pretty bad, much lower than its 5-year average and the index. For return on equity, also lower than its 5-year and the index. Same goes for its return on invested capital, worse than both its comparisons. As for its key metrics, 3M's gross margins are lower than its 5-year average. For operating margins, much lower than its 5-year. And same goes for its comparison for net margins, even including the index. If you're a dividend investor, 3M is really quite good since it pays $6 per share, translating to a 6.05% yield. Including its buyback yield of 1.32%, you've got an annual yield of 7.37%, which is good, and compared to its 5-year average, it's much better. When we look at the payout ratio, 3M's paying 61.67% of its profits to shareholders, which is quite high, but less than its 5-year average. The balance sheet is a snapshot of 3M's financial health during its most recent quarter. We see its assets, which is trending up, liabilities, which is trending down, debt, which is trending down, equity, which is trending up, and cash holdings are trending down. Looking at free cash flow, right now 3M isn't so much swimming in cash coming through and it's trending down. What I see from its key financials, 3M isn't that great of a business even with the lawsuit behind them. We'll have to see then what other analysts think of the company. When we see what price analysts give 3M, on the low end we see it at $96 and the high end at $123, with the average fair price at $112 per share. Looking at the 6 most recent recommendations, all maintain a neutral recommendation. Even when we look at Graham's number, book value at $14, earnings at negative $2, we get a Graham number of $1.78 per share, making 3M incredibly expensive right now. And since the Graham number doesn't accept a negative EPS, I just made it simple at 1 cent. But unlike analysts and Benjamin Graham who are too conservative, I have a different fair price. But before we get to that, join my Patreon. You'll get access to every grade from every company I've analyzed. It's updated all the time. Go to patreon.com/GrowthShares or click on the link in the description. We can probably all agree, 3M has different valuations for a rather poor company, but should you buy it at its current price? I give 3M a fair price of $143.77 per share. Right now the stock is very undervalued, and you'll see that many long-term investors will think so too. In the end, I give 3M a final grade of 44 out of 99. Overall, a poorly company, but with the earplug settlement behind us, I'd wait to see if the business can improve in the next few months and years. Tell me what you think of 3M. Invest wisely, and as always, take care of your money.